Imagine your broke cousin maxing out 10 credit cards, missing every payment, and then somehow convincing the government to bail him out because if I go down, then everyone goes down with me. Now imagine your cousin is every major bank in America. That's basically the 2008 financial crisis. One day, everyone was buying houses, flipping houses, refinancing houses, and treating their mortgages like monopoly money. The next, the economy collapsed faster than your confidence after checking your bank balance. Trillions vanished, jobs evaporated, and somehow, the people responsible still got bonuses. So what happened? How did something as boring as housing loans break the entire world? And what if I told you? It could totally happen again? Let's rewind a little, back to the early 2000s. The economy was booming. People felt unstoppable. If you had a pulse, a pen, and an internet connection, you could get a mortgage. Banks were handing them out like candy on Halloween. Didn't matter if you had good credit, bad credit, or no credit. Didn't matter if you made 6 figures or 6 excuses. If you could fog a mirror, you could buy a house. The American dream was in full swing. People believed owning a home wasn't just a goal. It was their birthright. And banks were like, sure, why not? Here's a loan you can't afford. Have fun. At first, it seemed great. People bought homes, sold them for more, then bought bigger ones. House prices were going up so fast, people thought they couldn't lose. It was a nationwide game of musical chairs, except everyone assumed there'd always be enough chairs. But here's where it got wild. The banks didn't want to hold all those risky mortgages. They knew if even a small percentage of people stopped paying, they'd be in trouble. So they came up with a brilliant plan. They'd sell the risk to someone else. Wall Street stepped in like the dealer at a casino and said, "We'll take those mortgages off your hands." They took thousands of home loans, good and bad, mixed them all together, and turned them into a new investment called a mortgage-backed security, or MBS. Think of it like blending a smoothie. You've got fresh strawberries, some decent bananas, and one rotten apple. You can't really taste the apple once it's mixed in, right? So they sold cups of that smoothie to investors and said, "Don't worry, it's all delicious." Investors, banks, hedge funds, pension plans loved it. The returns were high, and credit rating agencies gave these bundles the highest possible grade, AAA. AAA means extremely safe, like grandma's savings bond, safe. Except, these weren't savings bonds. They were time bombs, and nobody cared, because as long as the money was rolling in, everyone looked the other way. But Wall Street wasn't done. No, they thought, how can we make this even dumber? More profitable? So they invented something called a CDO, or collateralized debt obligation. Basically, they took those same mortgage bundles and mixed them up again, like financial leftovers microwaved for the third time, and sold those to new investors. If that sounds confusing, don't worry. It confused everyone else too. Even the people selling them barely understood how they worked, but they didn't need to. All they needed to know was that they were making money, and for a while, it seemed unstoppable. Everyone was making money. The homeowners who flipped houses, the bankers who created loans out of thin air, the investors who bought those loans, and the Wall Street executives who turned greed into a business model. It was a feeding frenzy. People were refinancing their homes to buy boats, cars, and investment properties. Mortgage brokers were approving loans for people who couldn't even afford the paperwork. And the logic behind all this madness? Home prices always go up. That was it. That was the entire argument holding up the global economy. And when everyone believes something can't fail, that's usually the moment it does. By 2006, home prices had reached ridiculous levels. People were taking out ninja loans, no income, no job, no assets. Literally. That was the industry term. Banks were lending money to people who had zero chance of paying it back. But who cared? They'd just sell the loans anyway. It was greed on autopilot. And then, like every great party, it ended. The housing bubble popped. Prices stopped rising. And when they stopped rising, panic set in. Suddenly, people couldn't sell their homes for more than they owed. Mortgage payments started increasing. Defaults began to climb. When homeowners stopped paying, the banks lost money. When the banks lost money, investors lost confidence. And when investors lost confidence, the entire financial system started to unravel. Those shiny mortgage-backed securities turned out to be piles of garbage with glitter on top. They were supposed to be safe investments, but when people stopped paying mortgages, those investments collapsed. The dominoes started falling fast. Bear Stearns, gone. Countrywide, gone. And then, Lehman Brothers. Lehman Brothers was one of the oldest, biggest investment banks in America. They had billions invested in those toxic mortgage products. When the bubble burst, their balance sheet looked like a dumpster fire. They tried to find a buyer. Nobody wanted the mess. In September 2008, Lehman filed for bankruptcy, the largest in U.S. history, and that was the spark that lit the explosion. The financial system runs on one thing: trust. And in that moment, trust disappeared. Banks stopped lending to each other. Investors panicked. Stock markets crashed worldwide. Companies couldn't pay employees. Retirement accounts evaporated. Ordinary people who had nothing to do with Wall Street, lost homes, jobs, and savings. It was like pulling one wrong wire out of a spaceship mid-flight, and suddenly every light on the dashboard started flashing red. The system didn't just stumble, it went full zero-gravity chaos. And it didn't just stay in America. Those mortgage-backed securities and CDOs had been sold all over the world. European banks, Asian banks, even tiny countries like Iceland had loaded up on them. When the U.S. housing market crashed, everyone felt it. Factories in China shut down. Banks in Germany folded. The world went into a tailspin. Within weeks, panic had gone viral. The stock market dropped more than 40%. Unemployment skyrocketed. Millions of people lost their homes. And the phrase, "too big to fail," became the government's favorite excuse. Because the banks that caused the mess were now begging for help. The U.S. government, terrified that the entire system would collapse, stepped in with TARP, the Troubled Asset Relief Program, a $700 billion bailout. Basically, the taxpayers saved the same banks that had just burned their economy to the ground. It was like paying your burglar to fix your door. The logic was that if the big banks went down, everything would follow. So they had to save the arsonists to stop the fire. And it worked. Kind of. The financial system didn't collapse completely. But the public was furious. People were losing homes while CEOs got golden parachutes. It was one of the biggest public betrayals in modern history. When the dust settled, everyone started pointing fingers. Wall Street blamed homeowners for borrowing irresponsibly. Homeowners blamed Wall Street for predatory lending. Politicians blamed regulators. Regulators blamed unforeseeable circumstances. Translation: everyone messed up, but no one wanted to admit it. Congress held hearings. Executives testified. They all said some version of, "we didn't see it coming." Which is wild, because the warning signs were everywhere. In the end, almost no one went to jail. And the people who did were small fish, not the executives who crashed the planet. Because most of what they did wasn't technically illegal, just catastrophically stupid. The Federal Reserve slashed interest rates to zero. They pumped money into the economy to keep it alive, and slowly, painfully, things started to recover. But here's the thing. The recovery didn't feel like one. The stock market rebounded, sure. Banks bounced back. Executives got paid again. But ordinary people? They were stuck rebuilding from the rubble. It took years for employment to recover. Wages stagnated. The middle class shrank, and inequality grew wider than ever. The crisis exposed something uncomfortable. The system works great when you're at the top, and barely works when you're not. By 2012, the phrase "never again" was everywhere. New laws were passed, more regulation, more oversight. But you can't regulate greed out of human nature. Within a few years, new bubbles began forming. Crypto booms, speculative stocks, get-rich-quick, trading apps that turned gambling into a push notification. Different decade, same addiction. Because the 2008 crisis wasn't just about housing. It was about belief. Belief that prices would always go up, that risk didn't matter, that we were smarter than math. And when belief replaces logic, the crash is just a countdown. The most ironic part? The system that broke the world got rewarded for it. Banks merged, got bigger, richer, and more powerful. Meanwhile, millions never recovered fully. Their savings were gone, their credit destroyed, and their trust in the system permanently cracked. But the world moved on. Markets climbed again. People forgot. Until one day, they didn't. Because history loves a sequel. And here's the thing. The same warning signs that existed in 2008, insane housing prices, record debt, speculative markets, they're all back. We just gave them cooler names. This time, it's not just homes. It's crypto, AI stocks, leveraged ETFs, and companies worth billions that have never made a profit. It's the same game, new graphics. Every generation thinks they've figured out how to beat the system, but the system always wins because greed never goes out of style. So what's the takeaway? The 2008 crisis wasn't just a one-time failure. It was a mirror, showing what happens when optimism turns into delusion, when people believe profits are guaranteed and risk is someone else's problem. And as long as that mindset exists, history will keep rhyming. Because greed doesn't die. It just puts on a suit, changes its logo, and calls itself innovation. So, could it happen again? Maybe not in the exact same way. But somewhere, right now, someone's inventing the next can't-fail investment. And when it does fail, because it always does, we'll all pretend to be shocked again. So keep your eyes open. Don't fall for the hype. And when someone says, "This time it's different," remember, that's exactly what they said last time. If you enjoyed watching videos like this, hit that like, comment, and subscribe button.